The hardest thing is knowing who to trust and which direction to go. We're going to tokenize because it's better, and then we're going to tokenize because we're going to generate more revenue. And in that world, we tokenize ID, we tokenize records, we tokenize messaging. That's a world where it's just better to use blockchain. I'm earning fees off the treasury. I'm earning interest off the treasury. So I'm making all the way. So this is why stablecoins are so exciting. I pay to store gold. It's an asset. It's really important to me, but it sits there on my balance sheet doing nothing. Gold-backed stablecoins are really attractive. Gold is a big one. People are starting to value gold a lot more. You deposit real estate tokens into their infrastructure and then borrow against it, take money off chain and go do something with that money. Web3 companies that have been debanked. Look at what these same banks did in 2008. Look at the handouts they took, the money they took. The fundamental principle upon which we founded was to protect the freedoms of individuals and their data. So I should have the right to choose that my genome that is traded for $4,000 a year, my records of what medicines I take or don't take, which gets traded for $189 a year and you don't realize it's being traded, and freedom of movement and freedom of speech and freedom to conduct business. Web3 solves a lot of problems of Web2 and Web2 solves a lot of problems with Web3. All society should be able to participate in that value. Not one small organization that harvests it all. And I believe in free markets, but free markets get ugly when they get monopolies. They become monopolies.
Hey, this is Darius and welcome back to Founders Unchained. And today we have a special guest, Mathew Harrowing, who is the CEO and founder of company Instruxi. And today mainly we're going to discuss about tokenization and real-world assets. So thank you, Mathew, for joining this episode. It's really a pleasure, and I'm really excited to go throughout this discussion because I think it will be very valuable for our community, for people who are interested in tokenization and real-world asset tokenization.
Thank you, Darius. It's a pleasure to be here.
So, Mathew, for the people who don't know you, can you just introduce yourself and just give us a little bit of details about the background, what you do, how you actually came to that field, to that business, and most importantly, how we can help with startups?
Certainly, thank you for that. I've got to say, I think I would classify myself as a reluctant entrepreneur. There are some people who feel it in their blood and in their veins that they have to build an empire. And for me, it's rather always been about necessity. My first ever business was while I was at university, and the necessity that I had was I was doing night shifts, packing gravy cubes in boxes, standing on my feet overnight with a machine that would close the box after I'd put the gravy cubes in it. And I thought, I can't do 3 years of university doing night shifts and packing. So I set up a computer company with relationships I had in motherboards manufacturing in China. That's another story. But I was able to start bringing in motherboards and VGA cards and building PCs for students, really. And then some teachers started to buy them. And then I started working in networking. And by the time university had finished, I had a nice functioning business. And that was my first ever experience in business. And it was really born of necessity. But then I had an opportunity to work in corporate. And that was marvelous. So a few years in Fitch ratings, and then several years in PricewaterhouseCoopers, which was a stunning business and a stunning place to get trained, working on some great projects. And then I set up a business with a fellow from PwC, and that did rather well. So it was really a mix of corporate and entrepreneurship. And through the way, I ended up working in Ernst Young and meeting some incredibly bright people and some people that directed me towards kind of thinking about Web3 at an enterprise level and solving some of the problems about how an enterprise would think about using blockchain technology. By this time, I had got deep into distributed systems and finance and was able to kind of build my career. And back in 2016, I worked with an incredible team of engineers under the direction of people who really understood SAP, Oracle, and JD Edwards, and mentors like Paul Brody, who was the head of blockchain globally for Ernst Young. And we built an intercompany accounting platform using blockchain and launched it in 2016. And the problem we were trying to solve was, how do we make decentralized systems work with distributed systems and connect with general ledger, subledger, treasury management systems at an enterprise level seamlessly and securely? We worked on a few types of token structures to do this. We worked on a few different technology solutions, and we launched a product. We got a few patents along the way. And this enabled organizations to seamlessly perform intercompany reconciliations and postings between different ERP systems. And that's really where we got excited. And so I worked with some great people, both inside Ernst Young and outside, some wonderfully innovative people along the way, some really clever people who wanted to solve the same problem. And that's really where we've been focused since 2016. And Austin and I set up Instruxi to solve that problem. How do we get these two worlds and two different technologies to act as one ecosystem in a way that enterprises can leverage the benefits of blockchain without the headaches and without having to rewire their entire infrastructure?
So I believe you are in a really good position because you are building infrastructure, as I understand. So basically, currently you can hear a lot of companies who are speaking about how we can transfer ourselves from Web 2 to Web 3 and start using blockchain technology. And the real world asset tokenization is also something very trending right now. I just did analysis and I checked how many even venture capital, so huge funds are investing into the tokenized assets. I think BlackRock, we have like $10 trillion capitalization, and I think we invested around $500 billion already into the tokenized assets. To me, it looks like really future. More and more companies going to be in that field. So I think you are in the good position because you are developing something which allows companies actually to tokenize the assets. And I really wish you good luck with that, because I feel that you are really in good position and all you need just to carry on what you do.
It's been a tough journey.
Yeah, I know. I mean, this is the problem right now. People understand that this is needed and it's going forward as a new market or a new trend, let's say. But I'm not sure if all the people understand how it works. We have a feeling that it's a good thing, but we don't know how to do it. So I think in this episode, we can touch some of the elements where we can explain, what it takes actually to tokenize assets. Is it hard? Is it difficult? Maybe if we don't know what to do, maybe we can get the access to the experts like you, and you could help them also to organize all the strategy, to put everything in place. We're going to discuss about those things in this episode, and hopefully some of the guys will see it very interesting, and even some of the guys might be even building something in that field, and we need some support. We need to get access to the experts like you. Yeah, so speaking about the technology, Matthew, I think it's really important to touch maybe technicalities also. Can you just explain about your stack, how your technology looks like, what kind of elements it consists, and how to use it actually?
So thank you for asking the question. So the problem we're solving is really, how can enterprises leverage the benefits of blockchain? I think first I'd like to discuss the concept of the value proposition with blockchain a little differently.
Sure.
So to put that in the context of our stack. So 2021 value proposition for blockchain is very different from 2026 value proposition. Now, back in 2020, 2021, and I say that because that was where we had the bull market, the explosion, open finance, DeFi, and the biggest rugs that we ever saw in history and in our ecosystem. And there was a belief, almost a religious fervor, that Ethereum would become this giant compute layer where everything would occur and we would be able to tokenize everything and process everything. That really hasn't materialized. But what has materialized is the technology has moved on leaps and bounds. And if you think in any period of 5 years of any technology, of course it's going to move on. And innovation within the blockchain ecosystem has been phenomenal. Firstly, I'd like to think about what is the proposition for 2026 today. If I'm a CEO of a business, why do I care? Now, what we're seeing is legislation finally catching up with the ideas about the industry. But legislation is taking us to 2021 innovation, not 2026 innovation. So we've got this huge gap in legislation still today, with all of this exciting news about we can do this and this and this. It's all still very boring. We're all still thinking about taking the traditional banking system and putting it on rails to making it more efficient. Big deal, right? So what is so exciting about today? If we think of like the standard things we think about when we talk to business owners and to companies, how do I make money? What's the value proposition? Blockchain gives you entirely new concepts about generating revenue. So if you think what makes this really special is that you're able to decentralize parts of the governance frameworks that typically are centralized. So let me give you for an example. When you go into any enterprise, you typically have different passwords and IDs to log on to those systems. So one of the big issues when you're dealing with distributed compute is you might have, I've worked in businesses with 60 instances of SAP. Each one's got slightly different policies and governance, and of course you can consolidate the IDs and manage the governance, but what happens when you put in Oracle, JD Edwards, and you need to do consolidated reporting? Well, now I've got to move it to one box, move it to SAP HANA, and bring everything in. Well, what if the data's in Germany and I can't do that? And so we have these really complex ecosystems where we're matching Microsoft and all these systems. So if I want to do any kind of consolidated reporting, I've got to move data, bring data. That creates risk, that creates cost. It's inefficient. Now that data is free, it gets compromised. And so firstly, one of the exciting things about blockchain is that I could distribute governance. I no longer need to be tethered to the compute layer by me and my ID and my policies. I can rethink about how governance works and how architecture works. And when we're dealing with blockchain, everything centers around a public and private key pair. So now a signing event can be something that can augment your governance and security, and a wallet, abstracted or not, can augment your governance and security, can distribute liability to the actual owners of the information and data, control data and information, and re-architect about how we do things in a more efficient and secure way. For instance, my genome has been compromised. It was hacked. The companies I trusted my genome with have been compromised. And so who knows who has access to my data? Now, if my genome had a better security provision that I controlled using a wallet and that I knew who had access to it, then it wouldn't have been compromised. There is all sorts of new technologies that are coming forward to maintain privacy, improve security, improve efficiency, governance, and generate whole new ecosystems of revenue. So the value proposition is different. And we in Instruxi spend a lot of time working with clients on how do you mitigate risks? How do you improve your processes? How do you generate new revenue streams, and how do you reduce your costs? And people they're doing that with AI naturally. They're not doing that so well with blockchain. So how does the tech stack work? Well, in that ecosystem, in that world, we've got to solve a few technological problems, and we've got to make it really, really easy to deploy. So the first aha moment we had really came out of working with some really good federation frameworks, and we focused on data federation for many years, Austin and I, and we worked with a really good platform that would enable data federation across big data. So if I had multiple data systems, I could create a metadata layer, and I could push my query into the subsystems, and I could work through data catalogs rather than actually consolidating data. That had issues scaling, and there's lots of systems out there that do that, but that has a fundamental issue with scaling. And all data federation frameworks and data marketplaces fail at scaling because you have to centralize a lot of the compute. And what they end up being is huge caching frameworks. The first really aha moment we had was realizing that actually data scaling was about untethering you from the compute layer. Who am I? What can I do? Where can I do it? Now, when you go into Google, you've got your Gmail, you've got your ID that opens up Google Cloud, GCP, Same with Microsoft, same with SAP, all of these, and you've got great products that help consolidate those for cloud. They're centralized. So we realized if we could untether you, then you could become free against the compute layer and against the services layer that you want to access. And that was really the first aha moment. So we built a product called the Enforcer. And the Enforcer, we created a DDI, a decentralized ID that we integrated Chainlink with. And I believe we were the first, or one of the first, to use the Chainlink oracles to verify your ID. And so we tied who you are biometrically with partners like Clear, and we integrated several others, who you are, what you can do, so you can write open policy agents, cloud policies to a wallet, and where you can do it. If I want to say that you can read or write to this field, this row, this column in this database in the Web2 ecosystem, I can do that. So I can assign that against your ID and your wallet, and I can give you access to Web2 systems using the Enforcer. On the Web3 side, I can say you can trade $1 million of this asset on this platform on this day. You can do these certain functions. You can attest to these different reserves. This is your limit. So I can assign full cloud policies to you, regardless of the ecosystem that you're connecting with. So the first product we launched was the Enforcer. And what the Enforcer does, it solves the mid-office that you see, issues that you see in a bank. So blockchain's really, really good at the front office side of the ecosystem. I'm sending you value. That value is going to get you there quicker than anything else in a trustless way, and in a very efficient and low cost way. Wonderful. We need to unlock more of that. But the thing that was missing is the mid office. What can you trade? How much can you trade? Where can you trade? Who signs off the trade? That was missing. So the Enforcer was the first thing that we launched, and we created a product around it called Proof of Policy. But the Enforcer was really the thing that unlocked our tech stack. The Enforcer is a product, it's our biggest selling product. It's a governance first product. Who are you? What can you do? Where can you do it? The second thing was, now we have to communicate with the Web2 ecosystem. So the Enforcer was really the game changer for us about how we thought about governance and solving the mid-office. Now, a lot of people have focused on governance at the wallet level and put rules into the wallet, which is a really important part of this. But we had to take an overarching view. Who are you? What can you do? Where can you do it? We solved that problem. And so as part of solving that problem, we had to work with some great partners, Space and Time, StoreJ, in creating distributed, decentralized systems to enable us to deploy a governance layer in a decentralized way, supported by data systems that maintain the privacy of the individual that we were assigning policies to. So problem number one, solved, distributed governance. Problem number two was, now how do we talk to the Web2 ecosystem from Web3? And we go from decentralized to centralized. We have attack vectors. Now, Chainlink did a wonderful job in building great Oracle networks and making them available to us. And we have been working very closely with Chainlink for many, many years. In fact, my co-founder, Austin, after we worked together, EY, he went and joined Chainlink and spent some good time there. And when we came back together, we became really close with Chainlink, and we think they have some wonderful solutions. So what Chainlink have given us is, with their products like functions and proof of reserve and CRE, is an ability to use the Oracle network to validate the data sources that we're connecting to. And so we use them like Lego bricks. We're able to build workflows, and through the Enforcer, we're able to put rules about who can access those workflows and how they can govern those workflows. So our second product we launched was TrustSync. And TrustSync initially was about setting up proof of reserves using the Chainlink proof of reserves oracles. but building an attestation layer that makes it compliant with MiCA and the Genius Act, etc. So when we think about verifying treasury information, let's say, I've got $1 million that I want to place on chain, and I want to be able to do something with that. Well, the only place that proves that the $1 million is real is the treasury management system that enables me to mint the tokens to the equivalent of $1 million to say there are assets behind. So I have to be able to form a bridge to the treasury management system that says that the number is correct. And I have to be able to verify that bridge with a consensus mechanism so that when I take a number and I say, we've got $1 million of this asset, we can mint $1 million of this token on chain in our treasury contract, they have to work as one ecosystem. So governance over the top with the enforcer, and then the ability to connect to the Web 2 systems to verify using a consensus mechanism that we're connected to the right data. And there are other techniques. If you look at how zero-knowledge proofs work, especially around how space and time use theirs, some of their patents, some really interesting technologies to do that. So then we created a workflow with a multi-attestation signing event so that the number is the number, but also the number is independently attested to and authorized by the right people. Because if you think when you run payroll for your staff, you don't have one person run payroll that you don't check the number. There's always a second, a third, there's a follow-up. There's a reconciliation that's done. It is the same with real-world assets. It's the same with bridging Web 2 and Web 3. There must be an independent verification or a signing process that is done by people who have authority to say the number is the number. So we built a framework called TrustSync to enable Web 2 and Web 3 data interoperability, but in a governed and controlled way. Now, as part of doing this, as part of building applications, and we started building applications for people, consulting with people, we built quite a stack of code, millions and millions of lines of data over the years, and solving lots of different problems along the way in terms of how the data interoperability works. So we ended up building tools over StoreJ, tools over sign-in with Ethereum, over Postgres, ended up creating an ecosystem, an edge framework that enables people to deploy and communicate quite rapidly. And so if you need to spin up any kind of, or provision any kind of decentralized distributed compute with the right kind of tooling, we developed a full stack to do that now, which was great. And so every tool that we built was really for us to be able to deliver client problems. And then we saw vibe coding just take off, and we started doing it ourselves, and it was amazing. So now everyone could do 10x of what they were doing. But this is really interesting. So part of what we have is a tokenization engine, and in there is all of the standard tokens that you would expect, treasury contracts, and then we created some of our own that we've had audited, and to enable multi-asset, multi-price type structures for really complex financial instruments. But we needed to know that when you're vibe coding, there was a determined outcome, not that you're having to rewire and replug everything time and time again. We needed to know that our smart contracts were not going to be altered. They were going to be deployed because they're audited. We needed to know our governance framework had to be deployed in a certain way. And so we built a vibe coding platform for ourselves using our own Lego bricks, let's say, and following our own methodology. And that's uBuild. We use that internally, and that is the Lego bricks, the millions of lines of code. So if I want to provision a database that communicates with the enforcer, that communicates with a wallet, that uses an ID, that integrates with Stripe or Privy or the standard tools or Fireblocks, we built that into our vibe coding platform. And now we have started enabling third parties to use the vibe coding platform to wrap their unique microservices into the platform and follow the deterministic pathway in order to deploy their tools with our tools very, very rapidly. And this has been organic, really. It's kind of taken a life on its own, and it's called uBuild, Instruxi uBuild. And effectively, we have clients who have specific skills. Let's say you have you have some really good quants, and there's a certain trade structure that you're really good at, and you want to market that, or you want to deploy that in a trading framework, and you want that governed. So the enforcer enables you to put the governance around that. The U-build enables you to build to that. And then your microservice, your solutions, your code is your IP. And we create an ecosystem within U-build that is becoming a catalog for people to create their own code, manage their own IP, but then resell that to our other customers. And that's really where U-build is. It's 50% of it is a methodology on how to build Web 2, Web 3 enterprise applications. The other 50% of it is code. But we're thinking about how do we protect our clients' IP and how do we reduce the amount of credits that they're burning because they're having to build everything all the time from scratch in an unstructured way. And we put a lot of structure around our vibe coding platform. So we're releasing this slowly to our first tier providers, and it has some uniqueness to it. We're not changing the world of AI. We're just making it easier, cheaper, and putting some strict rules around it. That's our third product. And it's just really a consolidation of everything we've done.
Thank you for this in-depth explanation. I really would like to ask you, you was mentioning cloud policies. You was speaking about the identity and the cloud policies. Can you just explain a bit about the cloud policies? What is it basically? How to understand that?
Yeah, certainly. In any ecosystem, you have permissions. And so those permissions enable you to do things. And there are billions of combinations. So when you go into AWS, as an administrator, I assign you the ability to access a database. Within the database, I can assign you an ability to communicate, to write to a certain table, or to only read, to run certain reports. And this creates huge amounts of policies. And most of those policies almost all those policies are tethered to the compute layer that you're going in. And public cloud has made that easy because we've created an ecosystem where they can all be governed from a centralized spot for the most part. But what happens if we're using multiple systems? Well, now we've got another cloud where I need other policies. And so there are products that I can build a workflow over both of these ecosystems, but those products are centralized. So the problem is if I think about the keys to the policies and my identity that assigns, there's a lot of trust. So if I can get into the policy engine, I can manipulate what I can and can't do. So by putting the keys to the policies in the same compute layer, and I appreciate everyone's got different ways of managing those keys, but if I can get to you and what you can do, then I've got control. And the more control I've got, then the more damage I can do. So when we talk about cloud policies, it's really permissions to do things. Now, in a Web3 world, we've got permissions to do things too. In certain of the enterprise wallets, I can give you permissions to trade certain assets on certain days, like I can in a bank in a trading system. Now, we need to bridge those two worlds together. I need to be able to bridge data access and Web3 access by removing the key management away from the compute layer, away from the cloud infrastructure, and decentralizing it, and then binding to that to you as an individual. I can force an event that says, prove that you are you, and I can link that to your biometrics. I can create passkeys and abstract away entirely the fact that you're using blockchain, but I can prove you are you. I can prove that your policies are only assigned to you. So let's say you're sending me and this is a real world use case that people use for our stack. You're sending me wiring instructions. It's a huge fraud area. I can prove that you have communicated the message, and I can prove that the message containing the wiring instructions have come from you, and only I can see them. And we have a cryptographic tunnel between two signing events that proves that the information has come and received from the authorized parties. And I can do that today, and we're doing that today. And because we're unlocked from the compute layer, I'm not sending through email, I'm not using compromised systems. we can create secure messaging, secure file transfer, secure asset transfer. So when we talk about cloud policies, in that situation, you're authorized to send me a message. I'm authorized to receive and sign that message, and you're authorized to use your ID to do that. And I know for certainty that you have sent and received it. This is what I mean by the value proposition for 2026 is so much more than the value proposition for 2020 and 2021. How our clients are using our stack. It's different. I mean, so we've got real world asset transfer, so value proposition, and we work with some wonderful partners around the Real World Asset Federation for tokenizing gold and other real world assets, and providing yield from those ecosystems and bridging the Web 2 and Web 3 value flywheels. And that they're wonderful for generating new revenue models. But to think beyond that, you are an asset. Your data is an asset. Your medical records are an asset. Your car, your house, etc. So when we think about not my keys, not my crypto, not my keys, not my data, not my keys, not my message, not my keys, not my ID.
This is what I really would like to ask you. What is your main focus right now? What class of assets you are tokenizing right now? And maybe you have also some view or vision where you would like to go with the tokenization in the future.
Yeah, so class of assets. So first off, part of our business is tokenizing medical records and messaging and IDs. And we consider those an asset and we treat them in the same way and they're governed in the same way. And so part of our organization is doing that. And another part of our organization is tokenizing real world assets. So we're working with third parties to tokenize gold. We've got 200 million of gold that we've launched with the Real World Asset Federation. And so that has created an ecosystem of borrowing and lending, which is going rather well. We've tokenized a lot of property over the time. Property is interesting. Some of the issues that people experience with real world asset tokenization is what to do with the tokens once it's been tokenized. So we've solved the confidence issue of is it good, bad property, is it owned, and through the whole governance framework, tying the on and off chain together. But still, people that have assets have been looking for people to buy those assets using tokenization, and you can do so much more. So the way that we've approached that is through stablecoins. So you have the assets, you tokenize the assets, you link the tokens to the asset, and then you create a stablecoin off the asset. And then you have an ecosystem that uses the stablecoin, generates fees. So you have the real world asset generating fees. In the Web 2 world, you have the real world asset generating fees. In the Web 3 world, you have accretive fees that can support each other for creating new financial products. So we're doing that. It's going really well. And we are looking for more gold, more silver, oil and gas. We have new discussions around doing carbon credits. Pretty much anything that's on a balance sheet can be tokenized.
The question from my side was always, and speaking with multiple people, what I noticed what we raise, how to prove the reserves, how I can trust that, this specific company has like specific reserve of gold. Can you just explain the process, what is behind the lines, how people can actually check, verify if that company is issuing the real world asset tokens and were verified and secure to buy? And it is trustable too. Because this is, I think, where the most people are getting the question, in their mind. Should I invest into the tokenized asset? How I can prove that it's real? And how I should check those things,
Asset quality has been a problem for us in the DeFi open finance world. I mean, we all got stung, I'm sure, by some of those stable coins back in 2020, 2021. Some of those Florida properties that came on that weren't real, some of those carbon credits that came on that weren't real. So you raise a really good problem, a really good question to an old problem. There's different parts of the component to this. So firstly, I don't have to say, is this an asset? Because we have an entire governance framework that defines what an asset is, both legally and from an accounting perspective. So is it on a balance sheet and how is it structured is the first question that we always ask. Is it real? Now, we've got some really good guidance from the Genius Act and from Mika about how to manage that on an ongoing basis. First question, is it on a balance sheet? And is it an institution, and does that institution control that asset in a governed way? I don't have to answer that question. I just need to know that they have the regular reporting and the internal control systems, and that's not compromised. The second thing is then we have to bind that balance sheet, wherever that information is, to the Web3 world, and that's where TrustSync comes in. Is it on a balance sheet independently attested to? Now, TrustSync must have the independent attestation on an ongoing basis. The number must be the number, and it must be independently attested to. So then whoever mints the asset must be able to put a legal hold on the asset to represent. So, and there's a number of different classifications you can do that. So in some classifications, in some legal jurisdictions, the token can represent custody. So if I hold the token, I hold the legal custody over the asset. In other, it works more like an ETF, where the asset is in a custodied environment, and I have access to the value of that in a legal structure. But so the legals have to be bound, depending on the structure and the jurisdiction that you're using. And so there's always lawyers involved, and there's licenses involved. So there is the data and the transfer of the information. The number is the number, binding the Web 2 and the Web 3 worlds from a technical perspective, binding them legally. Then there is the ongoing governance layer. Who has access to the asset? Well, that has to be controlled. And this is where we start with the governance structures. So there's always a lot of consulting that needs to go over. Who has access? What value they have access? What can they do? Can they rug their own token? Can they rug their own stablecoin? All of that has to be looked into. All of the smart contracts have to be audited. The process has to be audited. The governance over the ecosystem has to be reviewed independently. Now, once all of that is in place, then every other data element, let's say it's title deeds or it's certification of custody, whatever it is, they go into a decentralized data vault. And so we've got the data feed to the live systems, the decentralized objects. And so if I hold the token, I should be able to see all of the data, both objects and structured and unstructured data that tells me this asset is real. I should have confidence. This is the approach that we take. And Chainlink used the term golden thread, and I love the golden thread, but it's a golden thread from an IT perspective, from a legal perspective, and a governance perspective. And only until those three are bound as one ecosystem and operate as one ecosystem can you trust the tokens. So process, technology, and governance.
Perfect. Did you consider to build some kind of secondary marketplace where others can actually sell tokenized assets too, or not? Or this is not in your plans?
There are people coming into our ecosystem that have those already. We are going to stick very clearly to plumbing. We're going to support marketplaces. We're not going to launch our own marketplace. The marketplace that we will launch and what we are launching is around microservices for people who have unique things and unique code that they want to include into an ecosystem for what we do. So no, we're going to stay just behind the final layer of the application. We're never going to launch our own applications outside of tooling between Web 2 and Web 3.
So the question is, if I, for example, have an idea to build a business and I would like to be focused to the secondary market, I would like to involve all the players who are actually tokenizing assets, and I would like to build this marketplace. So is it possible for us to partner up, let's say, in this sense? I can actually tokenize the assets?
I would build it for you. You would launch it. I would build the whole platform. You would launch it. I would tokenize the assets, and I would form the framework to enable you to deploy very rapidly other people's assets, but you would run the marketplace. Or you could have someone else build it, and I would tokenize the assets and form the glue. Or I would give you my tools, and you would run an ecosystem of people. So long as they followed the process and the governance and methodology, you would feel comfortable to deploy all of our tools yourself. When you deploy your type of marketplace, there will be things that you will want that other people don't have. And therefore, we will build that into your governance framework where you would insist on X, Y, Z. And that would be your brand and your IP and everything. So we would help you get there. We will always stay within plumbing because we're really good at plumbing. and we're staying in that ecosystem because we're good at it, and it's just what we've done. We've always lived in the big data kind of bridging metadata world, and we're just going to stay here.
Okay. And what are the biggest friction points, let's say, for the companies who wants to go from I want to tokenize assets for actually going and doing this?
It's really interesting because the guys that have been tokenizing real world assets to date have been entrepreneurial. They've seen other people do it and they're exploring it and they've read up. And honestly, I've met some wonderful innovators, real thinkers, and been excited to participate in that journey. So the biggest issue for them is access to knowledge. And so the step one for these groundbreaking individuals who want to get into this ecosystem, who have assets perhaps or have an idea, is how do they get access to the right technology and the right knowledge? Because everyone's got their own methodologies, everyone's got their own paths. There isn't one way of doing this. And that's been very difficult because if you go to the top consulting firms, you will get a completely different answer. They will say, well, I could do this bit, but not this bit. And you go to the technology providers, well, we've got the wallet. Well, we've got the tokenization engine. Well, we've got the oracles. And I'm not seeing really true leadership at the top tier level. Now, of course, all of the top banks have got their providers, but if you're like a tier 2 and below business, you're doing a billion in revenue, where do you go? Who's supporting you? And so that market, they're really struggling. So we're providing services to that market, and a lot of that is consultation and discussion, and that's required every time because it's a completely different world. It's a different nomenclature, and there are very different risks. When we talk about liquidity, very different risks. The second biggest problem, so access to information, access to knowledge, which is why your channel is so important, which is why we've got to get better at providing guidance and online training. The second challenge is the why. What is the business value proposition? And a lot of people have read very good books from 5 years ago, have read the white papers from 10 years ago, and they're coming to the market with a vision that they're going to launch a token and everyone's going to buy it and number go up and they're going to be very rich. And that's not going to work. And that market isn't really there anymore. And so the value proposition needs to be really thought through. The tokenomics really designed very well, and they have to serve a purpose and a utility and value. And so what that looks like and what the value proposition is for blockchain is the second biggest issue, and how they can take their vision and apply it to today's market. Then there's the concept about liquidity. So I've got $1 billion in property, commercial real estate. I want to create more liquidity. I want to borrow against that. And so I want a hybrid token structure, stablecoin structure, because I'm really advanced and I know this. But now I'm faced with the fact I'm dealing with on-chain liquidity pools and on-chain open finance. How do I manage liquidity? How do I bring liquidity in to support? How do I bootstrap these projects? How do I work with a community that can safeguard my assets and ecosystem on chain? And how can I protect myself from really bad third parties and state actors in certain parts of the world who see me as free lunch? And so it really is the Wild West in some ways. And although we've carved ecosystems of safety within this world, there still is these really big open fields of lawlessness. And we're getting there, and they exist. And it's wonderful in some ways they exist because there's so much innovation that goes in those lawless territories. It's really where the hard tests occur. But we've got to guide people into the safe environments, keep their assets safe, and keep their reputation safe, which we can do now with technology. And so the hardest thing is knowing who to trust and which direction to go and to follow a path. And I'm not seeing the Moses of the Web3 world for businesses that have a serious use case for Web3 and fully understand this. So we're getting there. It's a start. I'm not seeing anyone who's really leading the way, thinking, putting the corporate first. I don't know if we're going to be that shining light, We certainly have an opinion. We've certainly been tested. We certainly can provide that safety, security, governance, and value transfer. We feel good about what we do, and we feel good about our coding and our approach. We would love to team up with other players. We actually formed a real world asset federation to agree on what is an asset before we even tokenize it. And we need more of those communities to define how we protect value.
Okay, so you were speaking a lot about the revenue streams, what tokenized assets can bring to the business and to the enterprises. I think maybe this is a good moment actually to invite other people, to consider or to think about the tokenization. And if you would pick, let's say, a couple of key industries, in your opinion, which has the most biggest potential to tokenize assets right now, today, what would it be? Like, what kind of segments you see as a really big potential?
Okay, so I'm going to split those into two components. We're going to tokenize because it's better, and then we're going to tokenize because we're going to generate more revenue. So those two worlds. So let's talk about an insurance company. Now, the first job out of uni I did was as a rating analyst for insurance companies. Wonderful learning. In the insurance world and in all financial services, assets flow between organizations, and there's huge amounts of reconciliation and waste that's done. But when we think about insurance specifically, I have a book. Let's say it's a motor book for Florida motor vehicles. That book has a certain risk profile. Now, I don't want to carry all of the risk for that motor book, so I portion some of that risk and I cede it to another company, a reinsurer. Now, that reinsurer has lots of motor books from lots of states. It doesn't want to carry all that risk. It cedes that risk to a portion of that risk to another reinsurer, and then we have retrocessions, and there are commissions. So I'm incentivized in different ways to accept them and partition that risk. Now, that goes on and on and on, and the first insurance company is so big, it has a reinsurance arm and it ends up buying its risk back. And so we've seen that happen with mortgage-backed securities. We've seen that happen with insurance. We've seen it happen pretty much in every asset class. And then we have this bubble because actually it's mispriced. Or if we look at what happened in 2008, I had triple-rated assets merged with junk assets that brought up the rating, that mispriced the risk. And so I was able to hide bad risk with good risk and misprice it. So in this world where we have all of this risk that is flying around, that we're buying back our own risk that's not being governed, when we tokenize real world assets and we tokenize books of risks and those type of assets, you can't buy back your own risk without knowing you're buying it back. It is completely governed and controlled between organizations. That is a far better way of governing risk across organizations in using the tokenization of real world assets. So, and in that world, we tokenize ID, we tokenize records, we tokenize messaging. That's a world where it's just better to use blockchain for, especially for interoperability, interbank, intrabank, these types of things. Now, the more kind of the typical real world assets we're tokenizing that generate new sources of income, which folks really like. So in that world, we see a lot of US treasuries being tokenized. And why? Because under the new legislation in America and happening elsewhere, if I have a big pile of treasuries and I can create a stable coin and I can find utility for that stable coin, well, I'm earning fees. I'm earning fees from the LP. I'm earning fees from the utility. I might be using it for intercompany balances or for cross-border transactions. I can do my own netting and settling. I'm reducing my third-party costs. I'm improving my visibility. I'm improving my reconciliation and governance. And I'm earning fees off the treasury. I'm earning interest off the treasury. So I'm making all the way. So this is why stablecoins are so exciting. So what if we switch out the treasury? And that's one thing that's growing really fast. Wonderful. What if we switch that out for, let's say, gold? Passive asset, boring. I pay to store gold. It's an asset. It's really important to me. But it sits there on my balance sheet doing nothing. Gold-backed stablecoins are really attractive. They can be used for collateral, for borrowing and lending. they're not exposed to the types of fluctuations that currencies are. They tend to be inflation and a hedge against inflation. So gold is a big one that we're seeing coming on because people are starting to value gold a lot more, especially as we're seeing the US dollar under a lot of pressure. I have an ability to take gold, and now I have an ability to earn an income by creating a currency off that gold and trading the currency. And we are seeing that, and we are working with partners who, quite frankly, have achieved 20% APY on gold, which is stunning, by creating an on-chain utility. Now, if I'm a listed business and I can create debt structures against, I've now got income for my gold, I can now issue bonds. I can issue bonds, buy more gold, generate yield. Beautiful. And I can use some of that yield to support yield generation in the ecosystem. Every country is different. We have to be really careful on the laws and work around that. Now, let's think about this with oil and gas. Oil and gas, the reserves tend to be proven. They're in the process. What you can effectively do is this with oil and gas reserves, or with reserves that have really clear, proven frameworks, so that they're on a balance sheet. There is a number on a balance sheet. They're in a process of extraction and refinement. So what effectively you're doing is you're taking a commodity, pretty much any commodity, where we tend to trade it once it's fully produced and refined, but you're sticking a flag further down the supply chain where there is real value that's on a balance sheet, and you're able to generate value further down the supply chain. And you're able to generate more value further down the supply chain. So accessing capital earlier.
Yeah, so actually the real estate example might be good. I know that, this tokenization era actually unlocks the new liquidity, new capital. What I believe, tokenization will bring to the market, it's additional liquidity and access to the retail investors to invest into the real estate. If the retail investors couldn't invest in the past, having just only $100, so right now we will be able to invest in real estate projects in New York and Paris, in other places around the world. And that is good for the projects because it unlocks for them additional opportunity to get the capital. And that enables retail investors also to have access to invest into those kind of deals. In the past, just only billion worth of companies had opportunity to invest into such big deals. But right now, this tokenization era is actually unlocks the opportunity to invest to others too.
So on real estate, you raise an excellent point, and I tend to gloss over real estate a little, primarily because of the some of the challenges improving that has occurred in the 2020s. So the retail market's a little jaded. But if you think, so what you just mentioned is getting access to the New York property market. But the beauty of tokenization is, one, you can create a basket of risk. So Dubai, New York, London, Paris, and you can create your own structures and your own risk profiles and have access to new types of instruments. So, but you can do several things here. So one is providing access to new investors and distributing that value and creating new financial risk frameworks and risk structures and instruments. But the second thing is, if I own real estate, I can tokenize that real estate and I can deposit those tokens in a platform. And there's a few out there. Rack.io are launching their iREIT product, which is borrowing, lending, deposit real estate tokens into their infrastructure, and then borrow against it, take money off chain and go do something with that money. And they're pegging at half US prime. So you have access to new forms of liquidity as well. But if I have sufficient assets, I can literally create my own currency, borrow against my assets with my own currency, and yield off that currency and yield off my assets. This is where the final leg that we're seeing today in 2026. I have gold assets, I have property assets, I have property in Germany, I have property in New York, I have stablecoin assets. I can create composite financial instruments, and I can have my quants create trade frameworks to earn yield off entirely new asset distributions. Imagine the ability to have a catalog of all different types of exotic instruments that are beyond our imagination, and a hypothecation of everything. everything. And we've barely even started.
Yeah, and another thing is what I really see the huge potential the companies, globally, we will be able also to get some liquidity to the business, actually collateralizing their assets instead of going to the standard financial system, to the banks asking for the loans. We will be able to collateralize their assets, and then this is how we can, get additional money to the business selling tokens to the retail.
The banks are putting up a fight. They have tried very, very hard to stop this, and now they're accepting it. And now the amount of Web3 companies that have been debanked for no reason whatsoever, other than they're too risky, it's astonishing. And yet, look at what these same banks did in 2008. Look at the handouts they took, the money they took from other organizations. Some of them chose to take money from crooks because the fines were cheaper than the loss of equity from the government bailout. And so I find it a real challenge whenever a bank expresses risk over how I run our business. Our books are audited. We run a clean business. I find the banking system just a little unfair in challenging. And it's not just us. All of us, like everyone in our business, has struggled to get banks to support us and support the growth of this ecosystem.
Okay, Mathew, how would the world would look like if Instruxi would be in charge in 5 years?
Thank you for asking. It's back in Ernst Young, we've got this concept of 20 square feet. What can you do within your 20 square feet? And it was a great way of thinking about what our proximity to the market, our control. What can we do? So we think that having a wallet is really important. The fundamental principle upon which we founded, Austin and I, was to protect the freedoms of individuals and their data. We disagree with being harvested by big tech companies and our likes, our dislikes, our data, our medical records being harvested without our consent and the value not coming back to us. And so I should have the right to choose that my genome that is traded for $4,000 a year, should have the right that it shouldn't be used for military purposes. I should have the right that my pharmacy benefits, my records of what medicines I take or don't take, which gets traded for $189 a year and you don't realize it's being traded. I should have the right to say yes or no, and I should also have the right to see some of the value if I say yes. We've started our business to build a platform to protect people's data and their assets. And so in our world, what this looks like is that you have a wallet and that you control your life, and that the freedom to operate and to govern and to determine what happens with your digital identity is given back to you. Your ability to vote and participate at a local level, your ability to control and protect your assets, your data, and your identity, and you become sovereign in your digital identity, in your digital world. That is our vision. We haven't deviated from that, and we believe there are other privacy advocates out there and other advocates who believe in what we believe in. And the value proposition is around unlocking the value for every citizen of the world so they can participate in a fair and open economy.
For sharing this vision. And by the way, I really also would like to share one interesting thought, let's say, what I actually got from discussions with fellow people. Everybody's speaking about the AI and everybody trying to think, what's going to happen in the future within 5 years or 10 years ahead. It looks like that the data will be the most important asset in the future because this data will be used by AI. And the question is, what kind of place the people going to have in this new world with AI? If we're going to have robotics and AI implemented on daily lives, we will start to sell the data.
Once that happens, then every business on earth is going to be incentivized to misuse your data for value. And we have a short window to protect the rights of individuals. And the second thing is value transfer. Instruxi works in primarily America and the United Kingdom, and we're opening up Europe. But my data is typically stored in America because of how the software that we use. We have our own ecosystems that we run for privacy. When you go into Microsoft Word and you write your thesis, you're generating value in the country that you're doing it, but that value, the electricity used to store the data, the water used to provide, the insights generated from that data, that's all going overseas and that is being taxed locally. And right now, there is a monopoly on where data is being held and where data is being monetized. And so there are some countries like the United Kingdom that can do better at wrestling some of that value back. But there are other countries that do not have any power, who are literally paying 50 cents on the dollar in tax to go to a place that gets all the value from their data and none of the value that's generated from it stays locally. We've got to do better at fairly distributing the value that data generates, and we've got to do better at protecting that and stopping these monopolies that are now infecting our governments and with a lot of capital to maintain their control. If they were benign, we wouldn't notice. They're no longer benign. They're actively seeking to limit freedoms and freedom of movement and freedom of speech and freedom to conduct business and putting in anti-competitive measures to protect their kingdoms. And that's a challenge. Let them go back to being benign, nice organizations that were hippies that thought they would get into IT, but they're not. They're becoming actively involved in government, actively involved in war, and actively involved in civil and removal of freedoms and civil liberties. That has to stop. And we see distributed and decentralized technology as a way to protect the future.
Yeah. So would you agree that this AI plus blockchain and tokenization, it's merges very, very nicely together? Just for example, I'm trying to work with ChatGPT on some specific topics. I'm trying to get some data from ChatGPT. It takes data from the library somewhere, which is already invented. I mean, if somebody was working on the same topic in the past, AI actually is going to bring this data to you, and you're going to use the same data. It's already invented or created. So at some point, I believe that it relates to what you said, that if we would be able to tokenize the assets or data, what we are producing working with AI, what we are inputting into the AI, maybe at some point in the future, we will be able also to earn money even from working with AI.
I agree. We give our AIs wallets. We give them IDs and we use the enforcer to say, you can do this and you can't do this. And what the enforcer does, it gives us an audit trail in a very binary way that says, yes, I did this, and I did this here. And so we govern our AIs exactly the same way we govern. Now, what's really interesting is the next evolution of the enforcer is to make it work at speed for agents, because agents work a lot quicker than we do. So the ability to govern agents in a controlled way, in a completely governed way, but then have an audit trail to do what they should have done. So, for instance, you're talking about that hallucination. Now, imagine that agent is selling an insurance policy, a regulated process. There are things they have to say. There are things that have to be signed off. You want your AI to follow a pattern, but you also want to prove that pattern was followed. And that's where the enforcer can support that. What did it do? Did it do it? In an immutable way. That's the beauty of blockchain. In all of this, the reason why we work with Web3, it's just a better way of doing things when we merge Web 2 and Web 3. Web 3 on its own, it's not going to get there. Web 2 and Web 3, Web 3 solves a lot of problems with Web 2, and Web 2 solves a lot of problems with Web 3. Now we augment AI into that, and now we have a governance framework to be able to distribute how AI works. So I completely agree. If you add something to the data ecosystem, you should get that value of that something. And that might be sufficient. And I guess my final point on this, when you get older, you're actually more valuable from a medical record perspective because you're more interesting. So it's inverse. Like we feel like we're not valuable, we're irrelevant I'm in my 50s. People have told me I'm irrelevant, which is fine because we ultimately do become. But my data is getting more valuable. And so I should be able to participate in that value, or society should be able to participate in that value, not one small organization that harvests it all.
Yeah, I agree.
And we've got to, and we think differently about that. Like if we have a smart city, the fact I get coffee way too much for a man of my age, and I live on coffee, is an interesting data point. Well, I should get the benefit, but my city should get the benefit. Distribute the value. The interesting thing, we've had cooperatives for hundreds of years, and cooperatives came as a rebellion against the Industrial Revolution, unethically harvesting the labor of working class people. They even created laws to stop you moving out of your county, so you couldn't go and get jobs, so the industrialists can control you. And I believe in free markets, but free markets get ugly when they get monopolies. They become monopolies.
Yeah,
And
I agree.
we have a chance of bringing this back into some kind of balance. And if we don't, it's going to look pretty ugly. And I don't want to leave that to my kids and my grandkids.
I agree. And thank you, Matthew, for joining this episode. I really appreciate our discussion. I'm pretty sure that for my community, it will be very interesting to hear what you say. And hopefully, somebody who wants to discuss tokenization, we can reach you out. I really wish you good luck with what you do. And I really love your vision. I really support your vision. And I'm pretty sure that we're going to have really nice partnerships in the future between us. Stay safe, good luck, and wish you the best.
Thank you. Likewise. Appreciate your time today. Have a wonderful day.